a stock market correction is being predicted. By who? By some doommonger? Is it by someone who keeps predicting stock markets year after year? No, this is by the Bank of England, no less. This is the UK central bank is predicting that there will be a stock market correction, and it's urging people to be cautious. Now, financial markets could see what they call a sharp downturn if investors start to rethink the prospects of economic recovery from COVID-19. This comes amid supply problems in the supply chain, rising prices, a spending squeeze, and this is all part of the warning of the Bank of England. So what do you think about it? Well, my personal view is that they are right. I've been talking about this for quite a while. Now, this comes from the UK's central bank's Financial Policy Committee, and it warned of what's called a correction. This is a correction. It's not a crash. Correction is defined as a drop of at least 10% in the price of shares from its peak. Well, its peak is really recently. It's at an all-time high, really. The bank has seen signs that increased risk-taking from from investment banks. Now, investment bankers and these funds that invest money on our behalf are basically people who get paid huge sums, huge salaries, sometimes millions of dollars, millions of pounds and bonuses to go and play with other people's money at the casino called the stock market and other markets as well. So just, if you think about that, would they be doing the same things if it was their own money? I don't think so. They invest their own money in maybe different ways. They protect themselves. But when it comes to you and me and our pension funds, they leave it in the markets to go down. Now, obviously, most of the money invested in the markets comes from investment banks. It goes through pension funds, unit trusts, investment trusts. The sort of institutions that really deal with our savings. They're pooled investments. In America, you might call it mutual funds. So this is where most of the money in the market comes from. There are individual investors in the stock market, but that's a tiny proportion compared to all of the institutional investors. And where do they get their money from? They get it from savers, from pension funds, from people investing in those funds. In the UK, we've got unit trusts, investment trusts, and in America, you've got mutual funds because they think that people can't understand the stock market, so they should invest only through them. But this is not true. You can learn how to invest in the stock market yourself. It's not as complicated as they would portray. Obviously, you need to learn it. You need to learn how to do it. But there's no reason why an average person could not do it. And the tools are there now. The live prices, it's all there for you. And you can get onto platforms very, very cheaply compared to years ago when you'd have to pay a lot of money to get a special line into the stock market. Now it's on the internet. Most of it is pretty much free. So stock indexes and markets. The index is the name given to particular stock indexes like the FT100 index, the Dow Jones index, the Nasdaq index, and it defines a particular sector in the overall stock market. But they've hit record levels this year. It's just been going up and up and up, and this comes from the earlier crash in 2020 when they sort of dropped by, I think it was 30 or 40% in a couple of days, and since then they've gone up and up and up. But investors are betting, of course, on a strong economic bounce from the pandemic. However, this is now countered, according to the Bank of England, by worrying levels of inflation, which the Bank of England said would be a temporary blip in the autumn, right? They said it might go up to 3% and then it will level off. No, that's not what's happened. It's actually gone to 4% or more and is predicted by the market to hit 6%. So obviously, the market is not taking much notice of the Bank of England. They don't agree with the governor of the Bank of England that it's a temporary blip. And strange enough, they don't listen to his warning today, because after this warning, the markets actually went up. The UK stock markets went up slightly. So they don't seem to be listening to the governor of the Bank of England. However, they're not playing with their own money, as I said earlier. So from this period, stock markets have gone up. Properties rocketed up this year, right? Very unusual, because people were in lockdown a lot of this time, and yet the markets were going up. Now, these worrying levels of inflation have actually hit not only the UK, but the US, where I think it's over 5%, and Germany, the highest inflation for 30 or 40 years. And this is sparking fears that growth could be stunted in the face of, as I said, supply chain bottleneck, difficult to get goods, right? For instance, car manufacturers can't get chips to go in the cars, so that's held up manufacturing. I think the car industry had one of its worst quarters ever in that autumn quarter just gone. So that's holding things up. It's obviously stopping economic growth when you can't get the goods you want, or that the cost of those goods and the cost of, say, building materials is rocketing. I was talking to a medium-sized property developer the other night. He said, we've got to be very careful at the moment, because you could quote for a price, you could say, right, you could project forward and say, this is what it's going to cost us to build these flats. But then with the prices going up of materials so fast, you could end up in a loss-making situation. Or if you're building for somebody else and you've quoted a fixed price, you could end up losing money on the work. So it's very worrying times, and that's just one problem. There are lots of other problems. There's also the soaring wholesale natural gas prices, and the skill shortages in Europe, where there's probably millions of jobs on offer, but there's not enough people to take them. The lorry driver shortage is threatening to wreck Christmas. People are already starting to order turkeys now in October for Christmas Day. That's how worried people are. And this lorry driver is threatening to stop food getting on the table, because farmers can't get pigs to the abattoirs, or slaughterhouses as it should be called, and they said they might have to cull pigs on the farm because they can't get them to slaughterhouses, or there's not enough workers in the slaughterhouses. There's not enough workers to pick the autumn crops. So there's all these things. Now, some of it might be the media going on about this and creating the problem, like I think they did with the petrol shortage. But a lot of it is true. There are soaring natural gas prices. They've gone up, I believe, by something like 400%. And millions of households are going to face a cold winter. Businesses could face a long winter of discontent from a cut in benefits to people, which means there's less money to spend on goods, a cut in state support for businesses, like the furlough scheme, which has just ended. And that's combined with the surge in energy prices that have not been seen since the 1970s, when the Arab oil crisis, when they jacked up the price of oil, as some of you who are a bit older might remember. And that sent the world economies into recession for a long time. So, there could be, and that also caused hyperinflation in the 70s in many countries. So just be careful and watch out for that. The bank is also concerned about higher borrowing taken up during the health emergency, and this could put more businesses at risk. Obviously, the more debt a business is carrying, the more risk they've got of failure, and the less chance they've got of riding out a storm like this winter coming. And apparently around 1.7 million companies took advantage of government support, including restrictions on winding up orders, business loans, and now we could see that those are coming home to roost. And as the economy recovers, the government support, including a restriction on these winding up orders, which means they restricted companies and lenders from winding companies up, from putting them into bankruptcy. That's starting to fall away. Like landlords now can gain possession of properties. So there's all these things that are stopping, and and a lot of companies are in big debt. Some of the companies were not really in debt before. They didn't really have much debt, and then they've gone out and taken these easy to get bounce back loans, 50,000 here, 50,000 there, and a lot of those are not even going to be repaid. We know figures from the ONS that a lot of the companies that took those loans will never repay them. Either they're just gone into liquidation, or they're fraudulently taken these loans to use for other purposes. So that was a fiasco. The banks had to give these loans out because they're backed by the taxpayer. If that will bail the banks out if the loans can't be repaid, but they didn't do the usual checks on just dishing out money to companies left, right, and centre like it was thrown around like confetti. And so now a lot of that money is not going to be paid back to the banks, and the banks will fall back on the guarantee provided by the government on our behalf with our money to guarantee these loans. What do you think about that? Do you think that's fair? I personally don't. But there you go. So that's what the Bank of England are worried about. That's why they think that when the market gets wind of this, that there will be a correction in the prices of stocks and shares, and that could plunge other sectors into a recession in this winter coming. We also know that China's debt bubble with Evergrande, Fantasia has not gone away. They're still expected to default on repayments, and that could cause other problems in the Far East, which could then have a knock-on effect in the West as property falls there, maybe defaults on bonds, defaults on loans, and then maybe less money for Chinese investors to go spending, buying up all the properties around the world, and that could cause a bit of a downturn there. I think, personally, I don't see any good news ahead. I just see problems. This natural gas prices could threaten to halt production of certain goods in the UK if the government don't act to put in place some sort of guarantee. The fact is, in the UK, we're not self-sufficient. We're dependent on overseas suppliers for food, for all sorts of things, for materials, for goods and services, and even I think 15% of our electricity comes from France, and we're in dispute with France over the fishing wars again, because there's problems with fishing boats in France, and goodness knows what. So that's still brewing, and France has threatened to even cut off electricity from us. Can you imagine that? I mean, even EDF, that a lot of us pay electricity to, is a French company. So a lot of our electricity is not even British suppliers now. So that's the situation we've got ourselves into over decades. Really, we've given away a lot of our manufacturing to the Far East. We used to build ships. We used to build most of our own cars here. We used to have massive steel plants. We've still got some steel plants. It's not completely finished, but we used to build most of the ships in the world. Now it's South Korea, it's other countries doing that, and we have to buy those goods and services in from other countries. So we're dependent on other countries in more ways than one. So how can you protect yourself if there is a stock market crash? Well, the answer is you need to educate yourself financially. Even if you don't directly invest in the stock market, you might think, well, it doesn't affect me. I'm not invested in the stock market, or I don't buy commercial property. Have a look at your pension fund, because your pension fund manager could be investing in those areas on your behalf with your money. Now, this doesn't apply if you're in a government pension scheme, because you're not affected by the ups and downs of the market. But if you're in a work-based pension scheme, a personal pension scheme, or a SIP, or something that is where most of the money will be invested in stocks, bonds and property, then you need to look at that. So ask your fund manager, is my portfolio in a high-risk fund? High risk would indicate something like 80 to 90% of the money into shares, into the stock market. Some funds might be 100% into shares or equities. Some funds could be 100% in shares, which means if the market goes down by 10% and your fund is worth £100,000, tomorrow it could be worth £90,000. It's that simple. So you need to look at that. If it's a medium or lower risk fund, it will have less proportion of investments directly into the stock market or shares, maybe 60%, 50%. You need to talk to your advisor about it. I'm not your financial advisor, but I'm telling you what I've learned when I was a financial advisor over many, many years in that industry, 25 years. I've done all the exams and all that sort of thing. So I still retain knowledge, although I'm not registered now as a financial advisor. But you need to get yourself educated, basically, so you know what you're doing. Read the small print, read the brochures, read the key fact sheets. A lot of people don't bother, in my experience. You give them a mortgage or a pension, they don't read it, they sign it and put it away in the drawer and forget about it. They don't even read the conditions. So this is what you need to start doing. This is what I go through on my Smart Money Manager courses, teaching people how to become more financially aware. So if you'd like to know more about investments, I put some free training up there. You can look at it, it's on demand. Click on the link and you can perhaps learn how to become more financially aware, learn how to become financially free. So thanks for listening, and just be careful out there. If you're invested directly in the stock market, just take a look, talk to your advisors. Don't just listen to me. it's your money at risk. You've got to talk to your own advisors about where this money is and what risk there is if there is a stock market correction, because a correction could be followed by a bigger fall, 15 to 20%, which could be a crash. We just don't know. It will come at some stage, because every few years, every decade or so, there is a correction because the market gets overblown, overheated, as it is now. Really, there's one of the reasons why it is so high at the moment is because the amount of money that governments in the US, Europe, and the UK have printed, quantitative easing, the amount of money that's been pushed into the market. We can see it from corporate takeovers. Like there's suddenly all this money, 7 billion to buy Morrison's in the UK from investment bankers. There's a lot of mergers and acquisitions going on at the moment, and that indicates that this quantitative easing, this money that's been printed, is in the hands of people that they can go and spend it. I don't see it. You don't see it. It trickles down to us, but the bankers at the top can get hold of this money and then do things with it. They can buy their own shares. They can invest in markets, and that pushes up the prices of the stock markets, and that's what's happened in the last year. They also printed money to stop stock markets falling, to stop a financial crash, to stop a 2008 happened. In fact, after 2008, they've printed trillions since then. I think the American debt stands at something like, is it 200 trillion in the UK? I just don't quote me on that figure, but it's certainly trillions of dollars. A trillion being 1,000 million. In the UK, the national debt is $2 trillion. Pounds, I mean, £2 trillion, and that's it's running close to 100% of our GDP for the year. So we are really indebted, and it would take decades to pay this debt off if they ever plan to pay it off. Now, inflation has other effects. Higher inflation, which is happening now, could push up the price of assets if there's buyers for those assets. It also means that if you owe money, if you're paying down mortgages, the value of those mortgages is inflated away as inflation goes up, because as you're paying it back, as long as you can afford the repayments, when you've paid that money back, the value of that money is less than it was when you borrowed it. So if you've got an interest only mortgage on an investment property, and you're paying the interest, borrowing say £1 million today, and you only have to pay that back in 20 years' time, it is going to be a much smaller sum if inflation has eaten away the value of that million. Do you see what I mean? So it has advantages sometimes for borrowers, but not so for ordinary people that are paying more for everything. You've got to watch that though, because when inflation gets higher, the normal blunt weapon, the blunt instrument to get rid of inflation is to increase interest rates. So I've seen high inflation. A lot of young people might say, well, inflation, what are you worried about inflation for? I've lived through inflation at in the 20% region, where unions were going on strike because they wanted a 25% pay rise for the mine workers or the train workers and this sort of thing, because they said prices are going up, we need more money. And I've seen that. And then what did the government do in those days? They put up interest rates to dampen things down. And then everyone is then suffering. People with mortgages are suffering then. But then investors who've got money in the bank do quite well. They get more money. But then, okay, so you get more money, more interest on your money, but everything else is costing you money. So it's a multifaceted thing to look at. And, we also face what's called stagflation, where, inflation is going up, but the economy is not even growing that much. And that could happen this year. But there's all sorts of things to take into account. The main thing is you read up on these things, you learn it, you understand it, and just protect yourself from risky investments. So do have a look at my training. It's there, it's free training. So great to see you all, and have a good evening. Thanks for listening. Bye for now. And thanks for everyone tuning in on Facebook Live and YouTube. Do click the like button. Do subscribe if you're on YouTube. And hi there to Ronnie and Shirley. Great to see you. Good to see you. Bye for now.